Welcome to episode 21 of The Rent Roll, your podcast on all things rental housing, apartments, SFR, BTR. Got some news to cover in this week's episode. Actually, quite a bit of news. The big six apartment REITs released their Q4 earnings and had their calls last week. We're going to recap those highlights, and we're still awaiting earnings and calls from the SFR REITs, as well as many of the mid-size and smaller apartment REITs. So we'll get to those in future episodes. But for the big six apartment REITs, a lot of great color coming out of those calls, including some pretty bullish tones on the supply-demand outlook. And then in today's interview, I'll have the privilege of bringing in the CEO of one of those apartment REITs, the great Rick Campo, co-founder and CEO of Camden. He always offers up great color and insight on the market. And so in addition to all the hot topics of today, I'm actually really eager to ask him about his famous on-hold music for his earnings calls. I won't give away all the kind of fun here, but I will tell you, when you call into a Camden's earnings call, and you can do that even as an investor, not have to be an analyst, or even just a potential investor, it's not your grandma's hold music. A lot of thought goes into this. And so I'll ask him about that, plus get into all the meat and potatoes as well. Before we do that, a couple of housekeeping items. Now, I promise not to do this every week, but I've been just blown away by the feedback for this podcast. Last week, the Rent Roll hit a new high at number 30 on the Apple charts among investing podcasts. Those are highest rating to date. And the Rent Roll is featured on Apple's business podcast page, if you scroll down far enough, that is, ranking number 102 among all business-related podcasts. So that's pretty crazy for our little niche podcast. So thanks again to everyone who's watching, listening, commenting, and rating the show, whether it's on Apple, Spotify, YouTube, Amazon, etc. It really motivates me to hopefully do this better every week. So thank you. Also, big thanks to our sponsor, Madera Residential, and you can check them out at maderaresidential.com. Continue to be grateful for Madera and their sponsorship. And on that, also want to share some personal news that I am thrilled and honored to, in addition to continuing to serve with Waymaker and Madera and offering up independent consulting and speaking, I'm going to be joining JPI in a part-time role as an economic advisor. If you don't already know this, JPI is a top apartment developer and a builder based in Dallas, has been a mainstay on the NMHC top 25 developer lists. I've known the JPI leadership team for quite a while. Peyton and Molly are absolutely first class in every way, two of the best people in multifamily, first and foremost as just human beings, but also as practitioners and leaders in the housing development space. Just always very thoughtful and data-driven in their approach. So honored to work with them and their teams. And of course, JPI was also the former employer of the new HUD Secretary, Scott Turner, who was just confirmed by the U.S. Senate last week. And congrats to Scott, by the way. He's going to be great in that role. So, anybody who knows me or reads any of my posts, I'm a big believer in supply as the solution for our nation's housing affordability and accessibility challenges. So I'm personally just really excited to better understand how supply gets built, the barriers to getting it built, and how to create more win-win solutions for our renters, for our communities, and for investors. I truly believe in win-wins. I just, it sounds kind of corny, but I think we always think about, at least in the kind of headlines in the media, about this tug of war between investors and renters. And, I don't believe in that. I believe that when we build housing, it should be a win for investors, renters, and for communities. When we do that, we create a more sustainable housing supply as well, and hopefully avoid the kind of extreme, peaks and valleys. And JPI really believes the same. That's one of the things that attracted me to JPI is their approach to not only bringing good returns to their investors, which is obviously critical for any sustainable business, especially one like building housing. You needs to be able to pencil out and bring a return so you get more of it, to build more housing, but also, building great sustainable communities for renters as well. And JPI is doing some really innovating and exciting things to overcome some of the cost challenges in today's environment for developing apartments. So I'm excited to be part of that and help out with market expansion and some other strategic initiatives. But again, I'll continue to do independent speaking roles and continuing to work with Waymaker Madera but excited to spend part of my time now with JPI as well. All right, so let's dive into the meat of today's episode. As always, kick it off with Here's the Chart. And in the Here's a Chart segment, we're going to be talking about highlights from the Big Six apartment REITs and their Q4 24 earnings calls, which just took place last week. So a hard pivot to REIT world. The Big Six are Avalon Bay, Camden, Equity Residential, Essex, MAA, and UDR. Again, I'll recap some of the key themes and highlights at a pretty high level. And if you want to get more detailed highlights and takeaways and quotes, I'm going to have that later this or sometime this week in my newsletter, Rental Housing Economics, which is, if you don't already subscribe to it, it's free, and you could find it at jparsons.com. All right, so theme number one, the tide is turning. All right, this is a quote that came out of something that retiring CEO of MAA, Eric Bolton, said. He said that while it will take some time for the recovery momentum to build, it seems clear that the tide is starting to turn. Seeing a big drop in supply, and this is paraphrasing briefly here, seeing a big drop in supply combined with strong demand. And then the rest of his quote, this strong positioning for the demand side of the equation, coupled with a material drop in new supply this year and beyond, we believe will have a significant impact on market rent growth across the portfolio for the next few years. Now, I'll share that MAA is forecasting modestly negative rents for new leases in 2025. So it appears they're really speaking to 2026 and beyond, but still seeing this transition point here. So let me give a few other details from their call. It's pretty interesting about this real focus on this transition point. And we'll talk to Rick Campo of Candid about this too. Incoming CEO of MAA, Brad Hill, said the seasonal decline in lease-over-lease rates was less than we've seen in previous years. And he also said that this pressure has continued to moderate in January, with blended pricing improving from the fourth quarter's performance more than in previous years. Now, to be clear, new lease rents are still sharply down due to the 50-year high in apartment supply hitting the market. For MAA, they were down 8% in Q4. Renewals were still up 4.2%. Blended was -2%. So it's still work to do. But what MAA is really trying to say here is that, again, that tide is at least starting to turn in the right direction. Occupancy for them is high at 95.6%. And as we talked about in the earnings call recaps from last quarter, everyone was really prioritizing occupancy over rent and continues to do that. And that, as the supply winds down, higher occupancy positions them and others for potentially faster recovery on rents. And again, this isn't just a REIT strategy. We see this across the board, and a similar story. And then I think hearing MAA talk about it is really just confirmation of things that we've been hearing across the industry or themes at NMHC as well. And then Tim Argo, another MAA executive, he said, we're pretty confident that over the next few months, we're in a good spot with occupancy to where we can, particularly as you get into the spring, you can start to push on pricing. Camden made similar comments on their call. In fact, the theme for their quarterly call was it's time to move on. And again, I'm going to dive into that more with Camden CEO Rick Campo later in the episode. But I want to quickly share one thing he said on his call. He said, we expect new supply pressure to lessen throughout 2025, setting the stage for a return to improve revenue and net operating income growth. And also interesting is both Candid and MAA singled out Tampa as a market recovering quicker among Sun Belt metros. MAA mentioned Orlando too. And by the way, Tampa, I talked about this previously in the multifamily Q1 update I gave in a few episodes back, is the first higher supplied Sun Belt market to see rents turn positive again on new leases. And also one, Tampa and Orlando, that my friend Greg Willett mentioned on one of the podcasts as well, as markets that could recover faster. So that at least is happening for these two. And by the way, it's not just, when we talk about the tide is turning, it's not just the Sun Belt. Obviously, we've seen more consistent performance in the Midwest and Mid-Atlantic and Northeast. But parts of the West Coast have also been taken on the chin these last few years for different reasons. And so I want to point out that Essex made a point to really highlight reemerging strength in the Bay Area of California, especially the Silicon Valley suburbs, thanks to return to work requirements among lenders. And also both in the Bay Area as well as in Seattle, we've heard some reports from the REITs about improving quality of life issues in some of the West Coast cities as well. Now, LA is a little bit of exception on leasing environment there. We'll talk about that in a moment. But overall, big theme, the tide is turning. All right, theme number 2 from the REITs earnings calls. REITs are builders again. Here's a really telling stat. Essex, again, big REIT in the West Coast. Essex is breaking ground on its first new development in more than 5 years. And this one's located around South San Francisco, where they see a unique opportunity to build. Obviously, in the West Coast, it's more challenging to build anyway. And then Avalon Bay's CEO, Ben Schall, he said in 2025, we're planning to increase development starts to $1.6 billion at a point in time when overall starts in the industry will be coming down, allowing us to secure stronger deals and returns. These developments will also face less competition when they lease up roughly in 2 years' time. By the end of this year, we expect to have $3.5 billion under construction, which is 50% higher than where we are today, setting the stage for a further uplift in earnings growth and value creation in 2026 and 2027. Avalon Bay later added that all these new projects are located in suburban submarkets and are less expensive wood frame construction, and the volume is concentrated in our expansion regions and in California. And by the way, for them, expansion means Texas, Colorado, Florida, and North Carolina. By the way, before I go on, I should really note here, I'm trying to recap these earnings calls. I'm not telling you buy, hold, sell analysis here at all. I'm not a financial analyst, and I don't give investment advice. And so I'm just sharing the things that I found to be interesting from these calls and kind of common threads from the different REITs. Let's talk about another REIT. MAA said that starts in 2024 were a record level for them. They broke ground on 5 projects totaling 2,300 units. They expect to start 3 to 4 more in 2025. Brad Hill, the incoming CEO, he said development is one of the best uses of capital that we have today, especially given what we think will be a diminished supply pipeline going forward. Now, remember that REITs, just because REITs are doing this doesn't mean everybody else is doing this. For those who aren't intimately familiar with the industry, it's important to know that most building apartments is not like building single-family homes. Most apartments are built by what's called merchant builders, who build apartments and then sell them. But in order to build, they have to raise capital from investors, which, of course, when you raise capital, it's more expensive than just funding it yourself. And so the REITs are generally able to develop from their own balance sheet, so they have a lower cost of capital, and that's an advantage for them, and also even on the private market, private sector, some of their peers that are large enough to have that scale and do something similar. But again, that's not the majority of the market. It's a small share of the market, and I don't know the exact number, but I would guess less than 10% of the market are REITs in terms of construction, and probably a lot less than that. So. In fact, just of the NMHC top 25 developers overall for apartments, they represented in most years less than 20% of all apartment starts. So in general, just the bigger players, it's not like single family. The bigger players are not that big in the big picture, both from a development standpoint and from an operating standpoint. So again, everyone wants to do this. Every developer in America is trying to raise capital off this strategy, kind of to build and develop into a lower supply environment in 26 and 27, but it seems fewer are likely going to be able to. Another REIT, Camden, talked about starting more projects in 2025. UDR said they could start 2 or 3 more projects this year. And I'll note that EQR was one exception to the trend. They seem a little less excited about new starts at the moment. They stated that new starts don't pencil out other than what they called the quote unquote simple product, or I guess you call more quote unquote cookie cutter suburban garden. And they generally prefer to be more upscale and upmarket from that. I also want to highlight that while there's always talk about development, everyone's also talking about acquisitions too, and especially of buying recent construction and sometimes even unstabilized projects still in lease up, where some of the REITs are trying to jump the line a little bit and acquire these properties if they can before most buyers are able to, because most are going to have to wait till these properties are stabilized and therefore eligible for agency debt. And so there are several REITs that talked about that strategy as well as a way to buy. All right, let's jump to trend number 3. immigration is mostly a non-issue. So there were lots of questions from analysts about new federal policy coming in on immigration, potential deportations, and potential impact to apartments. Generally for the REITs, they see this as a non-issue. They're all noting that, few recent immigrants live in market rate, professionally managed apartments like those owned by the REITs and their peers. They're generally going to be too expensive. I mean, these apartments are priced for mid and upper income households. And so I generally agree with the REITs on this. In fact, I talked about this at length with Chris Porter. I say at length. I talked about this a good bit with Chris Porter in episode 19 of this podcast, where we dove into immigration and demographics in more detail. But I did want to highlight one interesting comment made by MAA. They said they don't see an impact to demand, but could see an impact in another part of the business, construction. So Brad Hill said, we don't see a whole lot of impact from the changed immigration policies. Now, having said that, where I think we could see some impact associated with immigration would be perhaps on the new development area. And clearly that would have an impact on the ability of the market to ramp up construction. And they're, again, trying to be active in construction. So NAHB, National Association of Home Builders, they've shown some data that about 40% of the workforce in some construction trades are immigrants. And so clearly that would be a big deal and something to watch. But for demand fundamentals, in terms of direct impact, it's just not a big one. If there's a broader impact to the economy, obviously there would be, but direct impact is very, very minimal. Essex, and I think it was Essex, or maybe it was EQR. One of them mentioned that, H-1B visas play a small role, but that doesn't really appear to be where the challenges are, or potential challenges are in terms of housing demand. All right, takeaway number 4. And I hate to be pile on, because we talked about this as a takeaway from NMHC as well, but came up and again on the REIT earnings calls about Los Angeles. LA is continuing to be problematic. And some of the REIT executives note how that's been, I'm going to be careful with my words here, but just the political and regulatory environment has, kind of bordering on dysfunctional and discouraging of housing development. Essex and EQR even noted downside risk to performance should LA City Council adopt a rent freeze or another eviction moratorium. And by the way, I should point that everyone made a point of being very cautious about complying with anti-price gouging laws there. No one's really concerned about that as a dampener on the business at all, and kind of noted as just the right thing to do. But more just concerned with what the city of LA might do going forward. Essex, they said that they don't really see any impact to demand from the wildfires. They think it's more impacting single-family homes than it is apartments. But they did say, this is a quote, as far as the eviction moratoria is being concerned, what we are hoping for is a more sensible approach, unlike what was enacted during COVID, and that legislatures understand that the eviction moratorium is punitive only to housing providers and a bad policy for LA because it deters investments in LA and housing production in an area that already has an extreme shortage in housing, because we all know that the best path to affordable housing is just to produce more homes. And Essex also noted continued challenges with economic occupancy and rent collections in LA, all stemming from kind of COVID era policies. They're definitely seeing gradual improvement, but kind of the concern, I suppose, is that it could revert backwards depending on what LA does on policy. At EQR, Mark Parrell, their CEO, he was even more blunt. He said, if you want to encourage housing production, you have to send the right signals. And I think more and more regulation is not the signal. We're so encouraged about Seattle and San Francisco. They're doing so much better being pro-business and pro-housing. And we just hope LA comes along. That market is still not there on the government side, and we're going to continue to advocate for it to turn. So it's interesting that Mark compares, Bay Area and Seattle more favorably. Obviously, both are tough places to build, but haven't been as hostile as LA. And Essex, too, by the way. They noted better performances in those markets, with the exception of Oakland, Alameda County. Avalon Bay, another heavily concentrated coastal REIT, they didn't discuss LA directly on this, at least on this topic, but they continue to emphasize its commitment to reduce exposure to high regulatory risk markets like it. Ben Schall said, we are focused on, and they've talked about this previously, this is not new, but he said, we're also focused on further optimizing our portfolio by increasing exposure to select Sun Belt markets and some sub-markets. And we also see the benefits of diversifying away from certain risks, including our exposure to areas with less regulatory risk, including increasing our exposure to areas with less regulatory risk. We increased our expansion market presence to 10% from 8% in 2024. We expect to make further progress toward our 25% expansion market target in 2025. And again, for Avalon Bay, expansion markets mean mostly Sun Belt and Colorado. All right. And then we get to takeaway number 5. This will be the final takeaway from the Big Six REIT earnings calls for Among Apartments. Renters are in healthy financial shape. So, we're at 2 straight years where wage growth has outpaced new lease rent growth for apartments. Plus, of course, we've seen significant discounts to rent versus buy right now. So REITs continue to report positive trends on renter financial health, rent income ratios, rent collections, retention rates. UDR's Joe Fisher said, our residents' financial health remains resilient. The rent income ratio is below the long-term average. I'll touch back on that in a moment. I also want to share that a lot of talk about still high retention rates. Even with renewal rents growing more than new leases, although certainly renewals are growing less than they were in the past few years as well. But you're typically seeing 3, 4, maybe even 5% renewal rent growth compared to flat to negative on the new lease side. Even with that, retention's up. And renters continue to be able to afford the rent. I've talked about this a lot. There's a big focus across the industry on heads on beds, high occupancy, high retention, and it's generally paid off. And obviously, fewer move outs to home purchase play a role, but it's just one of many factors. And I think people talk about frictional costs of moving and whatnot, but obviously those are real. In many cases, you may get a renewal offer, you may shop around, and see, well, the rents are pretty comparable, or it's not big enough a discount to take on the moving costs. But vacancy is much higher today. It's not tremendously high, but it's in most markets we're in the anywhere from 5 to 7%, and that's back in kind of a normal range. And so there is availability, particularly in kind of down market and more the the B and C markets, in addition to the lease ups. And so for Class A renters and Class B plus, which is most of the REIT market, they can move down. There are options for cheaper apartments. And even with the moving costs factored in, they can even double up if affordability is a challenge. But there's no sign of either one of those things happening yet on any scale. And so that just tells you that, first of all, renters are in good shape financially, at least for the market rate professionally managed market, not the entirety of the U.S. rental market. And also the efforts to boost retention are paying off in addition to the external variables. So everyone's pretty much reporting low turnover, high retention. I want to highlight one thing that Equity Residential's Michael Manella said. He said, our fourth quarter turnover was just 9%, bringing our full year turnover to 42.5%, which is the lowest we've reported in our 30-year history as a public company. This clearly demonstrates our success in creating remarkable resident experiences and reflects our favorable supply-demand dynamics in our portfolio. And it's EQR's average reported rent is about $3,100. That's 72% above the U.S. average. So affordability is not a big factor in that segment. These are renters who have plenty of options. They can move to cheaper apartments if they wanted to, but most just aren't. And so again, affordability is a real challenge in our country, but just generally not in this segment of the market. Let's go back to UDR for a moment. If you can see my screen, they shared this chart in their Q4 investor presentation. And what it shows is their rent income ratios. And you can see the blue line, if you can see it, is dropping way below the green line, which is long-term average. So their long-term average is just under 23%. They're currently showing, looks like a little above 21%. And so, call it, let's say, a little under 200 bips below the long-term average. And one of the lowest numbers, even lower than what they saw kind of prior to COVID timeframe, or at least similar. And so that's the effect of rents that are the new lease rents growing slower than wages over these last couple of years, and supplies doing what it's supposed to do. And that reminds me of another chart that I've shared previously showing rent income ratios among REITs relative to the U.S. Census data. And if you can see this, it's a powerful chart. If not, I'll summarize it for you. It shows, based on public disclosures, this is as of last year, rent income ratios in the low 20% range among most of these REITs. And the Invitation Homes and the SFR side was under 20%. Camden was also low under 20%. EQR, MAA, UDR, all 20, 21% range. RealPage shows renters and properties on their platforms were 20, 23% of income spent on rent. Now compare that to the census stats, the entire population, where half the population is spending more than 30% of income on rent, and the median is 31%. And so it really shows you that, affordability challenges are real, but they're just not concentrated where most people are looking. And if you don't know where the problem is, you can't solve it. So you got to get better at lasering in on problems and creating targeted solutions for housing affordability and supply. And that'll take us to rental housing trivia. All right, this week's question is, and by the way, if you follow me on LinkedIn or X, you probably should know the answer to this. I think I also mentioned this in one of the past podcasts, but Scott Turner was just confirmed last week by the U.S. Senate as the Secretary for Housing and Urban Development. So the question is, Scott Turner is the second former NFL player to become the U.S. Secretary of HUD. Who was the first? So give it some thought, and we'll answer that in a bit. Next up in the news. All right, got a few headlines this week. We'll start off with one from the Wall Street Journal. Speaking of Scott Turner, he gave an interview to the Wall Street Journal. It says, Fannie, Freddie, privatization, cost-cutting, and new name are priorities for HUD chief. Scott Turner says he plans to quickly launch a review to root out inefficiencies at the agency. All right, so there's a lot of question marks and unknowns on potentially reprivatizing Fannie and Freddie, taking them out of conservatorship. I would think one potential benefit, this wasn't in the article, one potential benefit if Scott talked about maybe quarterbacking this along with the Treasury Secretary and others. If that happens, I think, one potential benefit for multifamily would be de-risking politicalization of the agencies. If that slippery slope persists, we've seen these last few years, that could jeopardize the core mission of Fannie and Freddie of providing stable, liquid, affordable debt that results in more supply for renters. But one thing that the Treasury Secretary pointed out is that the impact on mortgage rates from what happens to the GSEs is what he called the most important data point to factor into a potential exit. And so that comment suggests that maybe they'd consider retaining the implicit guarantee of a government bailout in a worst case scenario. Obviously, some in the White House want that implicit guarantee removed. But the White House has signaled that it wants to get mortgage rates down even more than the Fed's base rate, which are obviously related, of course. So you'd think it'd have to maybe factor in. Scott Turner in this article also talked about seeking to ease federal regulations to help housing costs and encourage state and local governments to do the same. Also quoting from the article here, he would do the same. He would continue to work on opportunity zones as a way to encourage investment in low-income areas. Turner would also like to change the name of HUD to better reflect its reach, which he said should include or does include rural and tribal communities. He said a new name would take a lot of time and conversation and thought and would require congressional support. Next headline comes from the Tampa Bay Times. New bill would crack down on corporations buying Florida homes. The bill would help distinguish between traditional owner-occupied single-family homes and rental homes owned by corporations. So from the Tampa Times, it said, a bill filed in the Florida House of Representatives Wednesday can make it more difficult for Wall Street-backed landlords to buy homes in the Sunshine State. It would distinguish between traditional owner-occupied single-family homes and rental homes owned by corporations. These rentals would be categorized as single-family hybrid housing, and local governments would have the power to prohibit them in certain neighborhoods through zoning rules. So this is a good reminder that, half-baked housing policy solutions get proposed in blue states and red states alike. We picked on Los Angeles earlier, but it's happening all over the country. And in this case, it's pretty wild to see something like this get media attention. And none of the articles I read bothered to point out the obvious unintended side effects, aside from some cursory quotes given allowed from the National Rental Home Council, which is represents single-family rental operators. So, obviously, number one, such a policy is going to discriminate against renters who can't afford to buy a home or don't want to buy a home for various reasons. And so it just raises the question that no one ever talks about other than, again, these rental housing groups, which is, are renters not worthy of living in certain neighborhoods? And we really want to bar renters from living in certain areas. I mean, that's a pretty discriminatory statement to make. And we also shouldn't be naive enough to think that everybody who's renting a single-family home would just buy one if they were available or if they could, or if a single-family rental owner didn't own that house. Anybody who actually looks at this stuff knows it's not that simple. And so there's ample research showing that single-family rentals help diversify neighborhoods with people who couldn't otherwise afford to or want to live in a for-sale home in that same neighborhood. And obviously, too, this is just going to discourage supply creation. We've seen the home builders talk about this. In new subdivisions, they're able to build more and build faster because they get some guaranteed cash from SFR investors who can operate a small share of homes in the community as rentals. So it's a win-win on housing supply, not less housing supply, it's more. And I'll say one other thing too, is I think articles like this too, they tend to overstate the role of single family investors. So, this one was, this article in Tampa Bay Times did a lot of back padding, and it said a first of its kind analysis of the Tampa Bay Times found that large corporations own more than 117,000 single family homes across Florida. But they didn't tell you there was any context. There's 5.7 million single family homes in Florida, according to the University of Florida. And so 117,000 amounts to 2% of the homes of the state's single family homes. So context matters, because without it, we get myths that create more finger pointing in the wrong direction, which leads to misguided policy solutions, which leads to unintended consequences. Plus, in the end, we're not solving the root problem if we're looking at the wrong places. So let's hope that common sense and facts prevail. All right, one more thing. Here's an interesting survey on investor appetite for 2025 from Private Equity Real Estate. The title is Investors' Private Real Estate Appetite for 2025. Top 3 sectors in this survey are data centers, healthcare, and multifamily/residential, which I'd assume includes SFR and BTR2. Industrial is 4th, retail is 5th. 27% of respondents said they plan to invest more capital in multifamily/residential in 2025. 54% said about the same as last year. Only 15% said they plan to invest less. And obviously, multifamily/SFR is much bigger than data centers or healthcare in terms of volume. So we'll see how this one plays out. Next up, new digs. All right, so we haven't done a new digs in a while. This is where we highlight a construction project. And this one comes from Bloomberg. JP Morgan's former Punch Card building unveils $10,000 rentals. Apartments in 55-year-old building originally built to house computers are hitting the market. This is in New York City, in Manhattan. So the nation's, maybe a little bit from this, the nation's biggest office to residential conversion is hitting the market with 1,300 apartments carved from a 1 million square foot brick fortress originally built to house computers and not much else. Rents will range from more than $3,000 a month for a studio to $10,000 a month for 3-bedroom apartments, not including an undisclosed amenity fee. Monthly rent for high floor apartments, which will be ready to rent in a few months, will be near $12,000. And a quarter of the apartments are planned to be offered at reduced rates through an affordable housing program approved by the state last year in exchange for tax abatements. Stairwells that once occupied Precious Corner real estate will be moved to the center of the building. That's got to be a big project. They also had to redo the exterior walls to add or expand windows. And they added 10 stories at the top of the building for more units. Inside, there's 100,000 square feet of amenity space, including pickleball courts, pool, gym, and spa, dug out from a basement that once housed a cafeteria for bank employees. And the developers working on this obtained a $536 million loan for the acquisition of the building, its existing debt, and the cost of conversion. So obviously, this is a much bigger project than most office residential conversions, but the complexity and cost reflect just how challenging these projects are to pull off, and why it's far more likely to see higher rent Class A product than affordable, unless a lot of subsidies are included. All right, let's come back to our rental housing trivia question for the week. The question was, Scott Turner is the second former NFL player to become the Secretary of HUD. Who was the first? And the answer is Jack Kemp, the MVP quarterback of the Buffalo Bills in the 1960s. After retiring from football in 1969, Kemp ran for Congress in 1970, entered office in 71, served there for 18 years before getting tabbed by George H.W. Bush, for the HUD job in 1989. And then, as you may recall, in 1996, he ran for Vice President of the United States as the running mate for Bob Dole. And of course, they lost to Bill Clinton and Al Gore that year. And that'll take us to the interview portion of today's podcast. And our guest today is a legend in the industry, Rick Campo, the CEO and co-founder of Camden Property Trust. Rick co-founded one of Camden's predecessor companies in 1982 with Keith Oden, and then took Camden public in 1993. Today, Camden owns nearly 60,000 apartment units across the country, from California to Washington, D.C., and most of it concentrated in between inside the Sun Belt. All right, now we're in the interview portion of today's podcast, and I am thrilled to be joined by the CEO of Camden, Rick Campo. So, Rick, first and foremost, thanks for making some time for us today.
Absolutely. Glad to be here, Jay. Thanks.
All right, so I got to tell you, I always like listening and reading some of the transcripts, earnings calls, and one of the things that makes Camden's calls unique is the hold music that teases out a theme for each quarter. And I don't know how long you've been doing this. Remember last year, one was Tom Petty's "The Waiting is the Hardest Part," tied to the impact of all the supply, and this time another Tom Petty song themed around "It's Time to Move On," suggesting an improving outlook. So I got to ask you, where did the idea for these theme songs come from? And I guess you also have to be a big Tom Petty fan, right?
Oh, no question. A big Tom Petty fan for sure. We've been doing the music and connecting music to a theme in our conference call for a long time. I would say over 20 years, probably now.
Wow,
maybe more. That's that. I don't want to age myself too much on that, but yeah. So the idea was, when you think about earnings calls with public companies, you when you're on hold, you listen to Gregorian chants or really lousy, elevator music. So we decided a long time ago we are going to just be different, and so we would use contemporary music, and so the way it starts is we start with a theme, like, okay, what's going on in the world, what's going on with analysts, what are they thinking about, and that kind of thing. And to your point, people were thinking about for the last couple of years about waiting is the hardest part of when's the market going to get better, and that kind of thing. And so it starts with a theme, and that theme usually starts with Keith Oden, the co-founder of Camden. He's our cultural warrior and
your disc jockey.
Yeah, disc jockey for sure. What he does is he and I will talk about themes, but then he comes up with what he thinks the theme is, and then he gives it to his assistant Natalie Byers, who's been his assistant for over 20 years, and I've had my assistant Janine for almost 40 years now. But so we have these really long-term folks, and the bottom line is that she then starts looking for key words in songs and finds them. We started this one with "Turn the Page," if you can imagine that. There's only one big song that comes out for that, which would be Bob Seger's "Turn the Page," right?
Oh, yeah.
And so then, well, "Turn the Page" is not exactly the right one. So we went to "Move On," and then that brought up Tom Petty. And yeah, the idea is to try to make it interesting and fun, but also communicate what we really want the market to know. And today, we're at 50-year high in supply, and that's what everybody's got on their mind. And it's time to move on from that, and time to get more constructive and get the term or the lyric we use is "It's time to move on, time to get going."
Yeah,
kind of the way we view kind of 2025 for Camden.
Yeah, Seeger is great. "Turn the Page" is a great song, but yeah, probably the tone isn't what you're going for with that song.
No,
right?
We want them to be upbeat. We want them to be, we used a Jimmy Buffett song in the fall, which was pretty interesting, right after Jimmy Buffett passed away, and it turned out to be a really good one as well. So yeah, you want to be upbeat, you want to be contemporary enough, and of course we were going to use Kendrick Lamar, Super Bowl, but you couldn't find any upbeat,
that's funny.
Relate to real estate in Camden.
Yeah, maybe his next album. All right, so I got to ask you, over the decades, I mean, you've been doing this long enough to know. I mean, you've heard analysts and investors every quarter talk about supply as the headwind for the Sun Belt, and I always joke it feels like copy and paste sometimes because it's just like the same things as every quarter after quarter. I want to run this by you. My sense is in the 2010s in particular, the Sun Belt outperformed because despite the narratives, there really just wasn't that much supply relative to demand, or certainly relative to what we see now. And then 2024 hits, or maybe end of 2023, we finally see what it means to build a lot of supply, 50-year high in completions. And when you build that much, there's a real impact on rent. So is that a fair synopsis?
Oh, absolutely. I think over the years since we've been doing this for, I think Keith and I calculated it was our 128th conference call, over 30, almost 34 years being a public company. And I will tell you, over that period of time, every single call is about supply. Supply. And what I say, and what I've tried to communicate over the years is supply is an interesting thing, but you have to think about demand as well. And I think the marketplace doesn't think about demand as much as they think about supply. And so the good news is that supply is you can tell what supply is, right? I mean, we know what it is. We also know that supply is plummeting right now. That new construction starts are way down in every single market, and the question is, what will demand be? But if you told me that we would have a 50-year supply of multifamily apartments coming into the market in 2024, and our top line revenue growth would be 1.3% or 1.1% plus or minus, and our net operating income growth for that same period for all of 2024 was going to grow at 1%, I would have told you you're on drugs.
Yeah.
That couldn't possibly happen. And what happened, obviously, was we had a massive supply, but we also had massive demand. And when you the Sun Belt has the great thing about the Sun Belt markets is that we have great demand, and you know what happens? We build the supply to meet that demand, and over a long period of time, it's pretty interesting. If you look at markets, for example, I'll give you the 10-year average of revenue growth in suburban properties in Tampa was 7% last 10 years, right? And so, wait a minute, you had all this supply, and you have 50-year supply, yet you have a 7% growth rate in revenue. If you look at Camden overall, our revenue growth was 4.5% in suburban properties over the last 10 years annually. Okay, well, what happened? Wasn't it oversupplied for the last 10 years? Yeah, well, it was. It wasn't oversupplied. What happened was we had enough supply enough demand to fill up that supply, and in a situation where we continue to do really, really well. And I think that the dynamics of those markets, the Sun Belt markets, will continue in that way over the next few years.
Yeah, no, I agree with you. And it's just on the demand side, especially. And, you've seen some headlines now too. It's like, oh, people are leaving Austin and Texas and going back. It's like, no, it's normalized a little bit, but these demand tailwinds are still quite strong, to your point.
Yeah, no question. So you look at Austin over the last 10 years, our Austin rents are up on average 5% a year. Not as much as Tampa. And the reason that Austin's only 5 is because the last year and a half it's been down, right?
Right.
And it's just a matter of time. The demand will continue to grow in Austin, just like the demand is going to continue to grow across the Sun Belt. And when you have pro-business governments, you have great weather, you have young people, you have growing households, in-migration. I mean, all those megatrends haven't stopped. They're continuing over a long period of time.
Yeah, I agree. So as we look at this now, we're at 2024, early 2025 supply. It appears like this is a generational supply high that results from a perfect storm of variables. All the stuff: the cheap debt, peak demand, inflationary rent growth, cap rate compression between asset classes. But now, as you mentioned, starts have plunged. At this point, everybody in the industry knows 26, 27 will be low supply, and even beyond that. So do you see any path to the market returning to 2024 supply levels again anytime in the next decade? Or does low supply become a structural tailwind over the next decade, and especially for the Sun Belt?
I think the short answer is absolutely not. When you think about this supply, the 50-year supply, if you go back to the 50 years ago, when actually I just started in my business career, just scary. Supply was driven by tax laws in those days. It was double declining depreciation, and people were building non-economic buildings to get tax losses, and that drove the market in the 70s and 80s pretty dramatically. And you're just not going to see the same kind of event. It's a once in a generation event or events that led to this 50-year supply peak, and I don't see that happening at all coming up in the next, just go looking 20 years ago or 10 years ago, or you have to go all the way back 50 to find, a time where supply was as high as it was. And if you think about 50 years ago, you didn't have the embedded base that you have today. So when you just look at those gross numbers, it's actually worse. It was worse 50 years ago than it was today because the base was so small. Right. So I think you're going to have I think that the tailwind's going to be in our business for at least the next 3 years, 4 years. And when you think about higher interest rates for longer and construction costs not coming down dramatically, and the pressure that rents have today on a relative basis, deals don't pencil. And The great news about the multifamily, business is that if you can't make a reasonable rate of return on your investment, guess what? You won't invest. And that's what's happening to the development market across the country right now.
And obviously, you're a Sun Belt believer, but I want to ask you anyway. I mean, how much do you think this lower supply environment benefits the Sun Belt in particular over the rest of the country?
Well, I think it benefits the Sun Belt more than it benefits the rest of the country. And the reason is there's more demand in the Sun Belt, right? Once you limit the supply, the demand is going to be there. We know. You look at Texas and Florida in the last 2 years. Census Bureau data came out, and there was over 1 million people that moved into those two markets in the last 2 years. And every single one of those people, those folks that moved there, need a place to live. So when you look at markets like Southern California, they had outmigration. There's negative population growth in New York and California, and the bottom line is that structural situation continues, and the benefit that the Sun Belt gets from higher demand and higher population growth will continue, I think.
Absolutely. So let me ask you about in your earnings call last week, you highlighted an unusual trio of outperforming markets: Southern California, Houston, and Washington, D.C. Three places that have very little in common. And so what made those three stand out?
Well, first of all, we're in 16 markets in the United States and District of Columbia, right? And the reason we are is because we want a balanced portfolio, because you never know which market is going to outperform versus another. And there's ebbs and flows in the economies. And the three markets that you just described have all three different things going on. Southern California, clearly you have a lower supply, but you've had lower demand there. And there just a lot of the Southern California growth that we've seen has been tailwinds driven by lack of lowering our bad debts. I mean, people actually paying their rent. So growth there is twofold. One is the economics are reasonably good for multifamily, but we're also being able to get our real estate back and lower bad debts. In terms of DC has been an interesting market because it didn't get way overbuilt the way maybe Austin and Nashville did. It's just been kind of go along, get along. And it was sort of underperforming for the last couple of years up to COVID, and then it's been really good over the last year and a half, which we think is going to continue in 2025. Houston was early to the supply game, and so there was a lot of supply that came into the market. And then I think people were a little nervous about the energy business and energy transition, so there is less supply in Houston. It's probably one of the least overbuilt markets in America today, and so it just has a different supply and demand dynamic than Austin and Dallas, where you have in Austin you have double-digit declines in rents, and in Dallas almost double digits, but in Houston you're kind of flat to up a little. And it's just, I think each market kind of goes to the tune of its own economic drivers, and that's why we have a balanced portfolio overall. We want to lower the volatility of our cash flow, and we kind of do it by being diversified across the country.
Yeah, I mean, obviously you pointed this out, but I don't think most people across the country realize how little Houston's built these last couple of years relative to its size. So let's talk about SoCal. You've generally been more pessimistic than your peers on SoCal, especially LA. I remember a quote you had in your Q3 24 earnings call. You called out LA for having a quote demand problem. And this last round of calls, and some of your peers, I thought it was interesting. For the first time, they've started to get, and I won't name names, but some of them pretty directly called out LA's regulatory climate as dysfunctional, unwelcoming to investment and development. And so, you've known this market for a long time. So what's changed in LA over the years since you first entered it, and what would it take to get interesting to Camden again?
Yeah. So, when you think about the other companies that talk about their markets, they talk about LA because they have a lot of property in LA and they're talking their book, right? And we only have 2 properties in LA proper and 1 in Long Beach, so it's not a huge part of our portfolio. But on the other hand, when you look at sort of COVID people who paid the rent, who didn't pay the rent, we have 10% plus or minus of our operating revenue that comes out of Southern California, and it was 50% of Camden's bad debts. Okay, and it's regulatory construct. I mean, what happens is the regulatory environment is very anti kind of business, And when you have blanket policies like you can't evict anybody for anything ever, right? And we had that for like 2.5 years during COVID. What's interesting, but on the one hand, what that does is it creates moral hazard because people who can pay the rent just don't, because there's no penalty for not paying your rent. So we have people, for example, in some of our LA buildings that are just $250,000. We're driving Teslas, still working, doing really well, calling us to fix things in their apartments and weren't paying the rent. And so that kind of environment is just not conducive for great long-term business. And it would take a whole lot for us to for a lot of change for us to get really constructive by increase our portfolio concentration to LA. I think the long term, when you think about California, in spite of all the dysfunctional aspects of what's going on there, people still live there. It's still the largest state. It's still one of the top economies in the country, and rent growth is good. And so in spite of sort of the issues you have to deal with, it's still a pretty good market to be in, long term, in spite of kind of the tension that you have from the complication of like having to work there.
And I guess in fairness, to point out too, and Mitch, kind of what you're alluding to, is it seems like outside of LA County is a better story. I mean, look at San Diego, Orange County, Riverside. This seems to be a better story.
Right. And when you look at Camden's portfolio, our portfolio is in the best parts of California. We have a few in LA, but most of them are in San Diego, Orange County. We have nothing in the Bay Area. We are fortunate to miss that party pretty significantly. We looked hard at expanding the Bay Area years ago, and I had the governor and others help trying to get us to go there, and we just couldn't get there. And part of it was as you point out, there's good parts of California and more complicated parts of California, and our portfolio happens to be in the best part of California for sure, XLA.
Yeah. Well, let's talk more broadly about regulatory risk. Not just SoCal, but let me just ask you this directly: Is policy risk the new supply risk for the next cycle? Meaning, does regulatory political risk become the primary headwind that apartment investors and developers have to navigate, and thus kind of impact where development and investment go?
I think it's definitely an issue in certain places. It definitely is an issue in California. It can be an issue in Colorado. Most of the markets, though, it's really not an issue. And there was a lot of discussion during the political campaigns, leading up to the presidential election in November, where the federal government was taking a really aggressive approach, including, if you go back to the Biden debates, his first 3 minutes, what talked about national rent control, right? And I think that dialogue is very different today, for obvious reasons, just because of the political environment. But I think that when you get down to the issues that people are dealing with, it's really about housing affordability. It's about how do you get more housing? We know we have a 4 or 5 million housing shortage in America, and I think the policies that we're hearing out of Washington today are a whole lot better than they were before. The only way to improve the housing pricing is to build more and not to control rents. I mean, every major, I don't know of an economist or a study that I've seen or has been produced by left-leaning or right-leaning, groups that don't say building housing is the most effective way to deal with housing cost and the price of housing. And so, while I think it's interesting and definitely something that we have to focus on from a policy perspective, I don't think it's going to be a major issue, because once you get rational people in a room, they understand that it's about building more and not less.
Yeah. Well, and to your point, I think about Austin. We've heard anecdotal stories of renewal rent cuts in Austin, which is obviously different rest of the country. I mean, if that was a rent controlled market, that would never happen, because
Right.
it would limit your ability to get it back.
No question. I mean, when you think about the housing, the issue of why housing costs so much, and not just apartments but single family, it's regulatory construct. I mean, NMHC did an analysis of what government regulation, how much of government regulation is included in the cost of building new apartments, It's 40% of the cost. Single family home builders had done the same study, National Home Builder Association. It's 28% of the cost of a new home. And when you think about that, it's getting government out of the way so you can, in fact, build properties and build more properties. We did an analysis, for example, of in affordable housing in Houston. And Camden we have a third party construction company, and we do a lot of affordable housing. We've done over $2 billion of affordable housing. We just build it for CDCs and other groups, tax credit deals and things like that. We can build a affordable housing unit for about $250,000, $225,000 a door here in Houston. If you take it to LA, it's $1 million.
Yeah.
Right now, what's the difference between Houston and LA? The wallboard's the same, the appliances are the same, all of the internal components of the building are exactly the same. The difference is land costs because of regulatory construct, and then all the other regulatory burdens that get put on to the construction process. And so it just the way to solve the housing problem is to build more.
Yeah, I know. I always tell people one of the most telling stats about LA is the fact that it costs more to build an affordable housing unit than a market rate unit in some cases. So pretty wild. So like a lot of investors, public and private both, Camden has stated interest in acquiring well-located, newer vintage assets across the Sun Belt. As you know, if that's a popular category, we're already seeing cap rates back in the fours because of ample demand from buyers that seem to be willing to take on negative leverage at least for a year because of their belief in the long-term story, but so far relatively few sellers. So how do you see that market shaken out over the next year? Do we finally see more volume?
I think you'll see more volume for sure, especially if we have higher rates for longer. What sellers have been doing, for the last year or two has been just kind of waiting, right? Hoping that supply will abate and that rental rates will, turn up and they'll be able to get back to the good old days in 2021 and 2022 when you had, really low cap rates. But I think that what's happening in the market today is that the idea that we're going to get to 3.5, 10-year is probably way off in the horizon. And so people are getting more realistic about what the long-term cost of funds are. And when you look at the long-term cost of funds and you look at what the operating fundamentals may look like in the future, I think that's why people are starting to move into the market, including us. We acquired a property in Leander, which is a suburb of Austin, in last month. And, it's a low cap rate, but it's a construction deal. It's 85% occupied. It was a low 4 cap rate. When it's full, it'll be a 5-ish kind of cap rate. But when you look at what's going to happen in Austin over the next 2 or 3 years, I think that what people are looking at is they're seeing clearly a drop off in the supply. And assuming you have a reasonable backdrop in the economy, you should have outsized rent growth in 26, 27, 28 that will make up for and drive that cap rate up so that you don't have negative leverage. So when you think about just about the market overall, the only way you can get new supply to pick up dramatically is to have the numbers work. So you need construction costs to stay stable. You need interest rates to come down. You need rental rates to stabilize. And until you get that, you're not going to build anything. And so you're going to have 250,000 units, maybe 280,000 units, most of which are tax credit deals. And so you're just not going to have any market rate units. So what's going to happen is you're going to have outsized rental growth in those years. And I think that's what people are planning on. So I think that sellers are getting more realistic because the longer they hold, especially a merchant builder, they have the preferred return that's continuing to eat away at their profit. They probably have profits still. They're just not as big as they thought they were in the past. So once you get more of that happening this year, sellers will come closer to buyers. Buyers will stretch on purchase price today with the knowledge that they're going to get outsized rent growth in 26, 7, and 8. And so it'll be I think we'll have definitely a more robust market this year. If you look at Camden, for example, and when we went back hard into the market after the great financial crisis, we acquired $2.7 billion of properties. We sold $3.8 billion and built $4.2 billion. And that's a great. It took a lot of work and effort, but we created a lot of value for Camden shareholders. And we're at the beginning of a cycle like that. I think that's going to last for the next 3 or 4 years, and we have a big budget to buy this year. We're projecting to buy 900 million, call it $1 billion plus or minus, and develop maybe 600-700 million, and then be in a position to also fund that through dispositions as well. So it's I think it will be a great time in 2025 to start that process, and it'll accelerate through the end of 25 and into 26 and 27.
Well, I still hope you're right. No, obviously a lot of brokers hope you're right for sure. So, well, let me ask you a related question that you touched on development too. So the narrative out there right now is that you could buy below replacement costs, but a number of the REITs, including Camden, are talking about ramping up development again. So how do you think about development opportunities relative to acquisitions right now? And related to that, what types of development projects can really make sense? What pencils out?
So I think selected development makes sense, but it can't. But we haven't been able to like really ramp it up hard because the numbers just don't work in a lot of cases. So we'll either sit on land or we'll wait until the numbers do work. But on a selected basis, you can get deals to work. And so fundamentally, we believe you need at least 100 to 150 basis point spread between acquisitions and development to take the development risk. And when you look at markets like Charlotte, for example, we started 2 projects in Charlotte in the last 6 months, and these are sort of 3-story walk-ups, very simple projects, not complicated, no podiums, no 6-7 stories, pretty decent, price per door. And when you look at the math on those generate a 6+% return. If I buy and on a unlevered IR, those are 8 and some change. On new developments or on acquisitions today, like our Austin deal, we bought that. We think once it's leased up, it'll be a 5-ish yield, and then over a period of time, the unleveraged IRR is going to be around 7.25%, and which will be wide of our weighted average cost of capital. So that's the way we kind of look at those transactions. If we can find development deals that work in that way, we'll build them. If we can't, then we won't. And so it's just an allocation of capital issue. We are able in the development side to trend our rents a little more aggressively in 26, 27, 28. So you're to get those numbers, you're probably betting that you are going to have a outsized rental growth happen in those in 26, 27, 28. So rather than just a kind of a 3% rent growth is what we kind of used in the past. Now you're probably going to have to take it up to 4.25 in 26, 27, 28 to be able to make those numbers work. But I think if we don't build a lot, which we know we're not, then rents have to move in order. Supply and demand is a simple thing. And when you have too much supply, guess what happens? When you have not enough supply and a high demand, look what happens. And so, people in America need a place to live, and we're going to oblige them by building some new product and creating value through the acquisitions and helping sellers kind of move from their next deal.
Yeah, and certainly if it's hard for REITs like Camden to build, it's even harder for merchant builders who control most of the market, given they have a higher cost of capital, have to raise equity and all that. So
no question.
Well, Rick, thank you so much for the time and the insights. Really appreciate having you on today.
Sure, absolutely, Jay. Always good talking to you.
And that's a wrap on episode 21 of the podcast. Again, a big thank you to Rick for taking time to talk to us today. And thank you to all of you for continuing to tune in on the podcast. We'll see you next time.